Glyn, here we are, coming towards the end of September, a very interesting month by all accounts for markets, as we're going to go on to discuss.
Yes, I suppose that September's been the month that we've all been looking forward to for the Federal Reserve decision on tapering, ever since Bernanke made his first public comments on the likelihood of a tapering of policy, a reining in of the asset purchases that the Fed has been making. He made those comments in late May. And ever since then, the market has focused its attention very much on September, the meeting of the Federal Open Market Committee in late September, where the market fully expected the decision to be taken on the first stages of tapering. So that was the big focus. But intriguingly, there was another, I think, very important issue that came along, that came out of the Middle East. We'd gone into September with a very high expectation globally that the US would have some sort of preemptive strike against Syria in return for the regime's use of chemical weapons. So there was a great deal of nervousness about that as we entered September. And of course, in the event, we had this really quite big surprise intervention from Russia, which has resulted in some sort of a deal being concocted, which the regime in Syria has agreed to, basically to eradicate chemical weapons by the middle of 2014. So it was a big month on those two critical issues, and both issues went in the exact opposite direction that the market was anticipating.
And as a result, if we translate those into market performance, what kind of returns were we seeing last month?
We had a very good month. It had been a difficult August. It was in the jargon a risk-off month. September was a very good month. It had started reasonly well. The Syrian news was filtering through, and there was a couple of other bits of encouraging news that helped the markets. But we saw overall the developed markets, MSCI World Developed Markets, rising by just under 6% for the month. Individual markets ranging between 3 or 4% for the US, up to nearly 10% for Japan. Very good month there. We had a very good recovery in the emerging markets. This had been a weak area all year, and August was a particularly bad month in the emerging markets. The global emerging market index for the month was up by nearly 9% a couple of days before the month end here. Big rises in some of the markets that have been hit hard in the previous month, like Brazil. Some of the Southeast Asian markets, India, had big rises, sharp recoveries in some of their currencies as well. But the other really notable feature, I think, in the month was the way that bond markets behaved. So we had good returns right across the whole fixed income sector, arguably led by what happened to US Treasuries, which actually in the event had a very good month. They started the week, they started the month on a weak note, ended up on a very strong note. All round a good month.
Absolutely. Looking at the data, let's start with the USA. How are things looking?
Well, the news remains mixed, it's fair to say, in the US. I think the broad pattern of a gradual recovery in the US economy is still intact, but there's no doubt that the news has remained mixed, and I think that was an important factor in the Fed's decision not to taper in September. And in particular, the numbers they focus on most of all, unemployment and the payrolls, were not as good as the market was anticipating. And they revised down the previous couple of months' numbers on payrolls, job creation. So that was certainly a factor in the Fed's decision. And as I say, mixed numbers overall from the economy. Consumer confidence a little bit weaker, but manufacturing, purchasing managers indices encouraging. Non-manufacturing PMIs very good, best for about 8 years. So the continuation of a sort of a mixed bag of numbers, but generally pointing to the US economy growing at around the sort of 2.5%-ish area over the next couple of years. So I think that pattern is in place, but we all know about the headwinds to that growth, of course, the fiscal challenges that exist in the US, the particular short-term issues that are coming up with the budget negotiations that are going on. I think all of these were factors in the Fed's decision not to taper. And the other important factor, incidentally, was the simple fact that there has already been a tightening of monetary conditions since Bernanke first made his comments in May about tapering. Since then, interest rates on government bonds have risen by over 1%. That's had an immediate impact on the cost of mortgages, and we've seen mortgage applications going down quite sharply in the US in recent weeks. So there's a clear indication there of some tightening that's already happened. So overall, mixed picture. I don't think it's changed dramatically from the previous month, and we haven't changed our view. This is not a robust recovery, and it's going to take some time to get sort of real good traction in the economy.
Absolutely. Central bank policy has obviously been a key driver behind markets. We're talking for quite a time now. There was a bit of a shake-up in the candidate race for the Fed chairmanship.
Yes, there was, and I think that was also a surprise to markets. There have been two leading candidates, Summers and Yellen. Summers has been viewed as the much more hawkish of the two, and it was generally thought that if he was appointed as the next Fed governor, he would probably rein in this very loose monetary policy somewhat sooner than the current trajectory. In the event, he actually pulled out of the race during the course of the month, leaving Janet Yellen pretty much as the clear front runner, likely to get the job. The market saw that as a much more dovish candidate getting in. The likelihood is that this very loose monetary policy will continue for longer. So I think that was actually quite significant. There was I think also quite a significant development in the ECB, the European Central Bank. Draghi again reaffirmed his commitment to keep short-term money market rates very low, even suggesting that they would engage in another long-term refinancing operation for the banks if that was required. So very clear that in Europe, interest rates are going to stay at these very, very low levels for a long time yet to come, at least a couple of years in my view.
Absolutely. In terms of central banks, the last one we were to talk about is the Bank of Japan, and here just this morning, that kind of explicit target of say 110 for the yen is back in the general kind of dialogue.
Yes, Japan had gone through quite a quiet period since its very sharp rise in markets earlier this year, late last year, earlier this year, since Abe became Prime Minister and the BOJ governor was changed. What we're seeing now, I think, is a sort of renewed commitment to this very loose policy. They clearly don't want to see the yen in any way strong. There are talks going on behind the scenes, we believe, about a corporation tax cut in Japan. It's a very business-friendly environment that's being encouraged, and of course, this commitment to the yen certainly not strengthening has got to be seen as good for the economy. The numbers coming out of Japan have been actually pretty good. They revised up second quarter GDP growth to 3.8% annualized. We've seen some quite good numbers coming out in terms of industrial production. Very positive scene in Japan, I think, and we still remain very, very positive about the equity market there.
And then moving, say, back to Europe, Germany and the elections at the weekend.
Yes, it was no surprise, of course, that Angela Merkel was re-elected. It was widely expected. It was clearly shown in the polls that she would win. She won by a bigger share of the vote than the market anticipated, so she is quite obviously now the most powerful politician in Europe by a mile. Because of the electoral system in Germany, she won't actually be able to govern without a coalition partner, which looks like it'll be the Social Democrats. We've had that situation before. I don't think it's in any way disruptive for Germany. I think it's sort of more of the same. But the one thing that is certain about Angela Merkel, although she's quite slow to move on big decisions, she's absolutely committed to the preservation of the euro. And I think we will now see a further round of sort of bailout for Greece, which has been on hold for quite some time until the German election is out of the way. She was hardly going to go into the election telling the electorate that's what she was going to do, but I think over the next few weeks and months we'll see more progress on that situation. And incidentally, across Europe we are still seeing signs of revival. We're still seeing some modest success from the austerity and restructuring programs. So I think that very gradual recovery not only remains intact, but is actually just beginning to get a little bit better.
Can I take it then from what we've seen last month, from what we know or expect, no change to your forward-looking view?
No, I think there were some big issues this month, and the Syrian situation has certainly helped markets. It was a factor in pushing down the gold price quite significantly this month. It was a factor in pushing down the oil price quite significantly, 6 or 7% this month. I think the other quite notable and arguably more important geopolitical situation that is evolving as we speak is this thawing of relations between Iran and the US, particularly since the election of the new Iranian president. And there's clearly now some movement towards a resolution of this nuclear problem in Iran. I think longer term that's going to be more important than the Syrian situation. That's certainly a positive. Lots of work to be done there, but a positive. The other big issue is, of course, the monetary position in the US. Remember, what the Fed has done, it's delayed tapering, not cancelled it. It will in due course taper. They won't go on with these asset purchases of $85 billion a month. But the message is very clear. The Fed has revised down its growth forecast for the next couple of years. It's maintained a very low sort of inflationary forecast. Inflation expectations are well anchored, not in the US and indeed elsewhere. So I think we're likely to see, and the message I think is clear from the Fed, that this very loose monetary policy is going to go on for longer than the market thinks. We've held that view for quite some time. They're going to remain very supportive, and the Fed will not take risks on reining that in too soon, given the relatively fragile state of the recovery in the economy, the fiscal headwinds, and in the immediate short term, the issues with the budget negotiations in the US. So I think the latter is relatively short term, but I think overall we're going to see this loose policy continuing for quite a long time yet.
And when you add that all together, loose policy, we're still reasonably happy with the position of the market?
Yes, they've had a good month. I think they're going to be nervous in the course of the next couple of weeks. We've got the budget negotiations I mentioned a couple of times in the US. Arguably, October the 1st, in a couple of days' time, is the start of a new fiscal year in the US. They have to come to an agreement in Congress on the new budget for the year. If they don't, the US government gets shut down. It's happened before. It's not a big issue. It's sort of noise, I think. Then on October the 16th, the US looks as if it's going to hit its debt ceiling, $16.7 trillion. There has to be an agreement in Congress to extend that. Of course it'll happen. You know, the US is not ultimately going to default on its obligations, but it creates nervousness in the market. We saw it a couple of years ago, the same sort of thing. But I think we'll pull through that sort of slightly nervous period. It really is noise. And underlying all of this, we've got this gradual but steady improvement in the US economy, the European economy, the Japanese economy. It's a very good environment for the corporate sector. As you said, very low interest rates for a long time to come, loose monetary policy still. Yeah, I think equity markets are still going to go higher over the next 12 months.
Glenn, thank you very much.